Welcome to All Stocks. Holy smokes, Clover Health has been on a rampage. We are getting SEC filings one after another, and in this video, I'm going to break down each and every one, take all of the variables, and input them in my intrinsic value calculator, and give you an updated price target. Now, before I start, I want to add one more thing. So you remember how on Monday, November 15, we had the introduction of the share dilution? Well, today, we had another share dilution. I got so many requests for this, and this is the video. I worked overtime, and here it is. All right, folks, as you can see, on November 15, Monday, we heard about the share dilution that Clover Health was offering for around $288 million. Now, an article was just posted that talks about how the share dilution is going to be at $5.75. So I know the document was a little long, like 300 pages, but it said it within the document on Monday that dilution and net tangible book value per share to new investors in this offering will be $5.74. So it's not really a surprise, but I guess a lot of investors I see on Twitter and Webull and Yahoo Finance, they're all talking about this article, and it really shows me that people didn't read this. It makes sense because it is a long document, which is one of the reasons why I created this channel to help educate people. Today, literally November 17, they just introduced an S1 MEF, which basically allows them to add an additional 20% shares in addition to the value here. So 20% of approximately $288 million would give you $56 million. So I looked at this document that was published, and within like 30 minutes to an hour, this document came online and it circulated the whole boards. So I wanted to make this video now that will encompass all of these additional shares at these values and introduce it into my intrinsic value calculation. So because of this, I have to update the shares outstanding. It's no longer 427.84 million. I mean, it still is. They haven't offered it yet, but they're going to offer it. So we're going to have to add 35 million plus 7.8 million. So altogether, we're going to have 470.64 million outstanding shares. And I'm going to put this in my intrinsic value. So when you see all those numbers, understand that they are going to be coming from these pre-slides that I have integrated for you here. So I just wanted to remind everyone that this company has already generated approximately $1.1 to $1.2 billion so far. We still have Q4. It's trading at a revenue multiple of 2.3, and it has a revenue growth of over 150% year over year. So these are the total revenues that I'm going to be using. The problem with this company is it's not free cash flow positive and the income is not positive, which makes sense because it is a growth company at these stages. However, to use an intrinsic value calculation, there's a little trick that you can use to estimate the value of the stock now. Before I show you that, I'm going to tell you what is my outlook on this company this year. Again, this is a very conservative outlook. As you can see, in Q1 of this year, they made around $200 million. Q2, 412. Q3, 427 million. Assuming that they're going to make the same amount of money, I think they're going to make more than they made in Q3, but let's just assume that they stayed the same. Altogether, they're going to have approximately $1.46 billion in revenue for 2021. I'm going to take the conservative approach and I'm going to use a revenue of $1.4 billion. That's assuming that Q4, they're only going to make $360 million, which is less than what they made in Q2 and in Q3. So this is exactly what I was talking about in transforming the revenue into an estimated free cash flow for the future. I did this by taking the revenue. As you can see, these are the revenues right here. This was the 1,400 that basically came from my estimation that was conservative. And what I did there is I took these revenues and I multiplied them by 5%. And in my intrinsic value calculator, I'm going to be taking all of these numbers and creating an average and extrapolate 10 years into the future and discount it back at a 10 to 15% discount rate into today's present value. I have to be clear. A lot of investors are upset regarding these share dilutions, and I understand. I don't blame you. It's right before the holidays. We were expecting something nice for Christmas to look forward to. This was taken directly from their S1. From 2018 to 2020, this company, Clover Health, was growing at 37% year over year for the annual growth rate. The beautiful part about this is that in 2021, we started to include direct contracting revenue, and then they started growing 150% year over year, even more than that, as I showed you in the previous slide. And on top of that, they're going to be doubling their direct contracting lives in 2022. The point that I'm trying to say here is that Clover Health needs to continue its growth rate extremely high. And if it doesn't, it's not going to be good for the stock in the long term. In fact, there's not going to be any pizzazz in the stock. It's going to stick around the $5 to $10 mark. And I'll show you this in my intrinsic value calculation. At the end, I will change the growth rate, assuming that this company will forever grow 37%, which is not good. I would rather personally, and again, this is my personal opinion, I would rather them dilute the crap out of the company in order to secure a higher revenue rate year over year to capitalize on the market to make the intrinsic value of the stock higher. All right, folks, this is my intrinsic value calculator. If you would like access to this, there's going to be a link in the description box below and in the pinned comment section. So all the numbers that I showed you, I'm going to input them here and I'm going to show you the intrinsic value of the stock. First off, I'm going to start with the compound annual growth rate from 2018 to 2021. Like I said, I'm going to be using $1.4 billion as I'm taking the conservative approach. Again, these numbers are in millions. Back in 2018, they had $281 million. This gives you a 71% short-term growth rate. Now for the free cash flows. I calculated them in the previous slides. You can go over and check how I got those numbers. The numbers are 14.05, 22.735, 34.5, and 70. It doesn't matter where you place them at, it just takes the average. As you can see, the numbers here are updated. We're going to go 10 years into the future and discount back at a 10% discount rate using a 2% perpetuity model. I will update this soon because of the recent CPI data. And then I'm dividing out with the new outstanding shares, including all of the dilutions, assuming that they just diluted them today. And that number is 470.64 million. Once you do that, you get $94.88. However, because of the taper that we're experiencing now, and I believe 2022, we're going to be getting a rate hike, possibly even two, I'm going to be assuming a 15% discount rate. Because of this, it drops the value of the stock to $42.51. Because the CPI data is approximately 6.2%, I'm going to show you here. As you can see, the CPI data is 6.2%. I'm going to take the halfway point between the normal 2% to 6.2, which is around 4. By placing 4 here, you see that the price jumps up to $48.81. Once the taper settles in and the inflation is transitory and we hit our inflection point, along with all the rate hikes that the Federal Reserve wants to do, and we get back at a 10% discount rate, you can automatically see that the fundamentals of this company haven't changed. If Clover Health can capitalize on these growth patterns, we can possibly see a stock price over the $100 mark. And that's based off of their numbers of 71% of the compound annual growth rate, which we know in 2022 is expected to double in the direct contracting lives, which means their revenue will reflect that. However, since we are living through these uncertain times, I'm going to be using a 15% discount rate. By doing that, you can see, like I stated, the share price goes down to $48.81. Now, do you remember that number I showed you from 2018 to 2020? The company was growing at a compound annual growth rate of 37%. If we update this, look at what happens to the share price. It goes down to $6.31, which is exactly where it's trading at right now. So a lot of investors are assuming that this growth is only going to be 37% year over year, which is not true because we know the direct contracting revenue was just introduced in Q2 of 2021. Now let's assume the company stops growing at a rapid rate and we start seeing a 37% year over year. Once the inflection point for inflation subsides, the interest rate hikes already happened. Let's drop this to 10% discount rate and let's go ahead and use a 2% perpetuity model. You can see the stock price is hovering at $11.63. So as you can see, that's been the range this stock has been trading at. People are assuming that this company is going to grow at 37%, which is not true. We already determined that this company is growing at 71% based off of the numbers, and these numbers are undervalued. I will be doing an updated price target utilizing numbers from 2022. So this is why it's important for this stock to invest a lot of money in its growth. And I'm going to explain to you why it's important that they diluted, why it's important they're raising cash. Because if they don't, then this company might not grow as fast. And if this company starts to grow 25% year over year, it's not going to look pretty. And especially if we do a 15% discount rate, it is not going to look pretty. A lot of people always ask me, what is your price target based off of my opinion? Well, I'm using a 71% year over year growth with a discount rate of 15%, utilizing a 4% perpetuity model because of inflation. However, I think inflation will be transitory and I'm sticking to 2% in this calculation. And my price target as of now is $43 based off of the numbers. Now, this could change if Q4's revenue drops significantly, which I don't think is going to happen, as we have heard that they're already doubling their direct contracting lives. Now that we went through my intrinsic value calculation, you see a lot of these Medicare recipients, they start applying for healthcare insurance at the beginning of the year. And Clover Health needs this money now to capitalize and getting as many patients as possible, especially when they're going into over 100 new counties, going into Alabama in the beginning of the year. They are expanding and they need that extra cash to secure as many patients as possible. That's why I think they did these share dilutions. If they don't secure these high revenue rates, then you saw the calculations, you saw the model. It's not going to look pretty. They need to do these dilutions to keep the revenue rate up. Once they understand how to minimize their operational expenses, we might be able to see Clover Health profitable even sooner than what we expected. Now, a lot of investors that came into this stock, they were expecting a GME/AMC short squeeze. Now, I'm not saying that that could not happen, but understand that this is a long-term company, and I keep on saying this is a 3 to 5 year hold. And just one thing I want to share. Warren Buffett says, be greedy when others are fearful and be fearful when others are greedy. There's a lot of blood on the streets. Majority of the people that are holding onto this stock are in the red. And according to Warren Buffett, and again, I'm not a financial advisor, this is just my opinion, I'm some guy on YouTube, this is exactly when you should double down. I'm gonna be eating all of these dips. This is such an undervalued stock. And in 5 years, you watch this channel. Holy smoking moly. Now, if you made it this far, consider liking, subscribing, and turning on all notifications. As always, it is my highest privilege and honor to provide you with this information. I'll see you on the next one.